Hello and welcome to the Fat-Tailed Thoughts podcast, where every week we bring you the makings of money, crypto, and the markets. My name's Stephen Dickens, and I'm joined, as always, by Jared Klee. Hey, Jared, welcome to the show.
Hey, Stephen, happy Friday. How are you?
Always good on a Friday. Always good on a Friday. I need a Friday, let's put it that way. I'm off to the UK for the first time in 3 years next week,
man.
so I need a weekend to get ready for that.
That's exciting. You might need a weekend to recover from that as well.
I've got a weekend in the UK. I don't think I'm planning on seeing some old high school buddies for a beer on Saturday night, so I don't think there'll be much recovery involved.
You're going to need more than a weekend to recover from that, my friend.
For sure. I said to my buddy yesterday, I said, we're not 18 anymore, and he's like, yeah, we're going to go for a nice meal and a glass of wine.
You say that, but I find as I hang out with older friends, I regress to whatever age I last saw them.
Yeah. So I've known this guy since I was 11. So this group of guys since I was 11. So hopefully I don't regress that far back. So this week we're on embedded finance again. I think this is going to be the gift that keeps on giving. I think there's a rich vein of topics. This week we're talking about buy now, pay later. So get us started. Let's dive straight in here. Massive growth in this part of the market. We've kind of gone from this not being a thing to this being a thing in sort of 12 months. So let's maybe start there. What are we talking? What is this? What's the massive growth?
I mean, basically, this is the story of finance during the pandemic. So prior to the pandemic, 2020, there's about $25 billion of purchases using buy now, pay later in the U.S. 2021. We saw $100 billion, 97, but who's counting? $100 billion of purchases using buy now, pay later. I mean, it's a wild amount of growth. It's making up a meaningful, call it 4 or 5% of online commerce. That's huge. And that is a totally different way of buying. It's different than credit cards. It's different than debit cards. It's different than, say, just cash. You can now often use it at point of sale in real stores. Using through your Square terminal or your Clover terminal or what have you. We've seen, go back in time, we've seen a lot of attempts at building new payment networks. A couple of years ago, it was MX something or other. It was launched by Walmart and a couple of other really big players, collectively accounting for north of $1 trillion in spend a year from consumers. And yet, after fits and starts, they said, we're only going to use this. We're not going to use Visa and MasterCard and the card networks anymore. They threw up their hands and they gave up. Consumers simply said, we're not having it. We like our credit cards. We like our debit cards. And yet, buy now, pay later, Affirm, Afterpay, Klarna, Zip, PayPal's Pay Later, they've made a massive impact in a very short period of time. Consumers and merchants alike are voting with, well, not their wallets, their phones, and saying, I like this new experience. And that's, Stephen, where I think we're going to focus the conversation. That, yes, there's an awesome growth story here, but frankly, the bigger story is you've got millions of consumers and merchants saying, I'm willing, and not only willing, enthusiastic about a new way of obtaining credit. And that is, we haven't seen that in a very, very long time.
We've also seen companies get acquired in this space. I'm trying to remember whether it was Affirm or Afterpay got acquired for, I want to say,
so Square, now Block, bought Afterpay. Afterpay, the majority of the footprint in Australia. They're actually one of the older buy now, pay later firms. They kind of dominated Australia and then expanded from there.
But that was a big acquisition, right? That was $27 billion, I think.
It was, and now it isn't. So Block paid the vast majority of that in shares. The original purchase price was $29 billion. By the time that deal closed, it was only worth about $13 billion. Still big, but not quite the same. Same number of shares, just not worth quite as much.
So it was buy now, pay half as much. Sorry, that was just too obvious a joke. I had to do that. If only you could get that deal on Amazon when you're doing buy now, pay later.
Exactly.
So I think everybody's seen this. Everybody's been through a checkout online and seen the option. maybe let's double click, if you excuse the pun, and we'll go down and understand a bit around the mechanics of this. So, I'm buying $100 microphone to go podcasting. I get pops the option, would I like to pay for this in 4 installments? That's typically the model here. Typically what I see as the consumer is the item stays $100 and I've got 4 $25 payments to make. Talk me through who's making money in that scenario, what the mechanics of this are. What are we seeing at the end user, me, the consumer? What are we seeing at the merchant? What are we seeing at the firm or Afterpay? And how does that break down?
So there's a bit of difference, and I'm going to kind of skirt over some of the nuances between a firm and Afterpay and the different offerings at first. We can come back to it. I want to get the basics down. Mm-hmm. So what you're talking about is called Pay in 4, and it is the most common model, especially in the U.S. for buy now, pay later. 25% of the purchase price up front, 25% in 3 installments every 2 weeks for the next 6 weeks. So at the end, you've paid that 100% of that $100 purchase price. For the merchant, it looks very similar to a credit card, meaning first off, they have to opt in to accepting it the same way they have to say, yes, I'm willing to accept cards. And then secondly, in the card payment system, they're getting paid. They submit the receipts, the IOUs, back to the Visa network, and they get paid out through that. Mm-hmm. At whatever the net rate is from Visa, from MasterCard, you name it. Typically, Visa, MasterCard take about 2% plus some cents. So you think on a cup of coffee, it'll come out to maybe 3-4% that the merchant pays Visa or MasterCard or the card network. In buy now, pay later, it's more often 5 or 6%. It's often double what they would pay the card network. Again, that merchant is getting paid basically upfront, not quite instantaneously, but near it from the buy now, pay later firm. Under the covers, what's happening, so that buy now, pay later has paid the merchant and then is getting paid back by the consumer over the next 6 weeks. On average, about 50% of those consumer payments are actually paid in advance, meaning even though on paper the duration of that loan is 6 weeks, on average, it's only actually about 3 weeks. Consumers prepay that back. The buy now, pay later firm is facilitating payments from the consumer via a debit or credit card back to the banks or whoever eventually is collecting the money. So if you look at those mechanics, let's just kind of break down the economics here. The merchant, as opposed to paying 3% to a card network, is paying 6% of the purchase price to the buy now, pay later firm. So that chunk of change funds a lot of what comes out of this. The consumer, as long as they pay on time, is still paying the same $100 price. They just get to pay it in installments rather than all up front. The buy now, pay later firm is facilitating loans from some capital provider like a bank to extend credit to the consumer that is paid upfront to the merchant.
And I think there's a couple of interesting things in what you just said, which maybe we'll come back to, the word loan and the word credit. But keep going. I just want to put that pin in those because we're going to come back to those, I think.
Really important ones to call out. So the buy now, pay later firm is effectively making money on a 6-week loan, and it's more facilitating that. It's not traditionally not the capital provider. So they'll take that 6% that they collect from the merchant. Part of that will get paid out to Visa, to MasterCard. Every time that person pays one of those installments, well, the buy now, pay later firm has to pay for those interchange fees on the network, so some of it will go there. Some of it will go back to the capital provider. Hey, you lent me money, I owe you back money on that loan. Some of it will go to basically paying for charge-offs. So somebody took out the 6-week loan and then failed to pay it back. Net, your buy now, pay later firms are going to have about a 2% yield on that 6-week loan. which, again, remember, it's actually, on average, they get paid back in 3 weeks. Stretch that math out. If you net out all that, your 2%, and some goes to Visa and some to the bank, split out all of that, what you end up with is about a 25% yield per year for the buy now, pay later firm.
So
if
that's
you extend 2% loan over your 52 weeks. And so it turns out to be a rather attractive business. And if you then think, well, I've got predictable loans, I can do a really good job with underwriting, et cetera, you can actually lever that up and make those returns even more attractive.
So they're making money, I think was the last point you made, they're making money in the transaction flow, but they're also capturing a really good insight into buying behaviors. They're inserted right, and this whole section's embedded finance. They're embedded at the point of transaction, so they not only know what was bought, they know the amount it was bought for, and they know who bought it. That puts them in a really unique position from a data point of view.
We're seeing kind of benefits of that already. So that SKU level data, individual products that were bought, a big differentiation between buy now, pay later and traditional cards. The buy now, pay later, they're underwriting individual transactions. Every time you say, hey, I want to do this in installments, they make a decision at the point of sale based on who you are, based on the product you're buying, based on that merchant and that experience, and go, yes, we will, no, we won't. That's different than a credit card. The credit card issuer is underwriting you. It's, hey, you can use this for any purchase and pay me back in 30 days or whatever the terms are. That is a very, very, very different model. The buy now, pay later, that product, that SKU level data, well, you could imagine them going to, say, LG or Samsung and saying, hey, can we bundle a financing offering with your TV, with your phone, that's now available at take your pick of the merchants, and you can turn it on, turn it off as you want. A credit card company cannot do that. They don't have the product, the SKU level data to actually create that type of offering. The buy now, pay later does. The second piece you hit on, that consumer insight, who they are, how they buy, why they buy, when they buy, where they buy. It's a wild amount of data. Affirm, 30% of the buy now, pay later loans that Affirm extended last year actually came through the Affirm app, meaning consumers are starting their purchasing journey through Affirm, not through the storefront and then opting into Affirm. That is one of the biggest reasons why merchants are okay paying the 5-6% fee to the buy now, pay later. They're treating it not as a transaction cost like they would for a credit card. It's a part of the customer acquisition cost. So they're thinking, hey, I could have spent that money on Facebook ads or Google ads or what have you. And by the way, you're paying those up front in the hope that people will come shop. Instead, I'll pay 5%, 6% of the transaction to Affirm. I only pay that on successful conversion of customers, but I get the same kind of advertising uplift because I'm getting a new channel, the Affirm app, to drive it to my store.
And is that because, and I mean, that's an interesting fact. I didn't realize that. Is that because people start their buyer's journey with, I want to buy a TV that's going to cost $1,000. I don't have $1,000. I can do this in 4 payments, but I can't do it in 1 payment. The place I start that journey, therefore, is through the lens of how much money I've got and when I've got that money. So I'll start looking at I can buy via Affirm because that's how I can finance it. And then I'll make my purchasing decision based on that, basically.
That's certainly part of it. Another part of it is generational. Buy now, pay later has seen much bigger uplift with Gen Z than it has with other generations. The app itself, and we could say this across the BNPL apps, they are designed with your gamification. There is now an Affirm Day, similar to the way you have Amazon Prime Day. There's this entire environment that lives there that celebrity sponsored and TikTok enabled and however else you want to describe this. It is designed for a different type of buying experience that appeals to a generation that oftentimes isn't eligible for credit cards because they don't have the credit. And even when they are, they tend to hate credit cards. There's actually a pretty funny study a couple of years ago, Gen Z, a couple thousand people. Second biggest fear was war. Third biggest fear was war. Second biggest fear was public speaking, and first biggest was credit cards.
Wow.
There's a whole generation that's been taught that credit cards are evil. You can get yourself into trouble. You can get yourself into debt. It'll take years and years to dig out of. And yet with buy now, pay later, it doesn't feel like credit, first off. But secondly, a 6-week payment to every 2 weeks on a per transaction basis. Pretty much anyone can predict their finances 6 weeks out. And if you know you're going to pay every 2 weeks, well, that's a much greater amount of control over how much money you're spending in your repayment period than, say, this kind of magic card that I can swipe for anything, and then I wake up at the end of the month and I go, oh, God, I can't pay that off.
So I want to take you back because you were going there in your last comments. You mentioned repayment periods, you mentioned credit. This is effectively a loan or a credit transaction. Let's go there for a moment. We've had, and you've mentioned the generational piece, we've had credit cards for years. We've had those payment rails for years. We've had that wide acceptance in the market by both merchants and consumers. We've seen this new thing emerge, and it literally is over the last 12 months, effectively providing a short-term loan and effectively doing a credit check in order to facilitate that short-term loan. But they're not a credit card company and they're not a bank. I see your face. You can probably pick up from my tone if you're just listening. There's something in that, I think. Yeah,
you might have another career as a regulator here. The Consumer Financial Protection Bureau, the CFPB, is pretty damn sure these are loans too. Even though they're not registered.
So let me get this straight. I'm loaning you money and you're repaying it back over a short period of time. Sounds like a loan to me. Maybe I'm not young enough to get the dynamic, but that sounds like a loan to me.
So this is regulatory arbitrage 101. So there are a number of regulations on the books that lenders have to comply with. Among the biggest at the federal level is called Truth in Lending. It governs a whole bunch of stuff, non-discrimination, and the terms you have to disclose to borrowers in clear, plain English. A bunch of stuff goes into it. Truth in Lending only kicks in for loans that have 5 or more installments. Guess why it's called Pay in 4? It's precisely to skirt underneath that set of requirements.
That won't be allowed to go for very long, I don't think.
Correct. So that, by the way, these regulations are written with good intention. So if you think
they were
about
written it also at a period of time where embedded finance wasn't a thing, nobody had heard of a firm. I don't know when Truth in Loans in Lending was kind of drafted.
We've had a number of updates over the years, but think about, let's take a different loan scenario to understand why it was designed this way. If you're a business and you send an invoice to somebody and you say, you can pay net 30, you can pay 30 days later, that's a loan. Let's be very clear. That is a loan, and yet you wouldn't have to embed all the normal disclosures and compliance. You wouldn't want to deal with that. There are a series of those scenarios. So the regulation created an arbitrary cutoff and said, okay, it's 5 or more. That'll make sure that we capture things like auto loans and what at the time made up the vast majority of consumer loans, but allows those, okay, it's net 30, but you can pay in 2 installments. Fine. That allows those to continue to function without the regulatory burden. What's happened with buy now, pay later is they went, ooh, that's a great opportunity. And they crafted a much bigger industry that's extending credit on, in the case of California, last year, 91% of the loans, consumer loans extended in California were buy now, pay later loans.
And by their full definition,
91%.
91% of them weren't regulated by loan regulation.
So they are now in California. California got a little bit out ahead of this, as they often do in the financial world. Their regulator came out maybe a year or two ago and said, nah, pretty damn sure these are loans. They are now, buy now, pay later is now required to register as a lender, comply with all the local state regulations, in expectation that will probably happen at the federal level. Here in the U.S., the CFPB a couple of months ago sent out a letter to the 5 biggest buy now, pay later firms in the country, and they're quote unquote collecting information.
Regulation ahead is the sign that we should be looking for.
So they put out a subsequent notice and said, by the way, we're really concerned about data aggregation. You're getting all these people that are shopping through your app. We're concerned about what you're doing with that data, how you're managing it, whether or not you're selling it to people. We're really concerned about the fact that people are perhaps taking on a lot more debt than they realized, and they'll wake up and not be able to pay back. The CFPB's starting to pay attention. It's gotten really big really quickly, and they want to make sure it doesn't get out of hand. And
I think, I'm not anti-innovation, as you well know, and if anybody follows me on social channels, I'm pro-innovation, but I think you and I share the stance that we're pro, I'm trying to think the right way to describe it, but pro-good regulation that protects consumers, protects entities in these types of new models and flows. And I think I'm encouraged by what you're telling me, which was new news to me around California and some of the I think, hey, it's a loan. The fact that it's 4 and the regulation kicks in at 5, that's a technicality that's
by the way, another fun one, the buy now, pay later, they don't pull credit. They don't do a hard credit check. Again, trying to skirt around that. But I think we have kind of struck a good balance here, and hats off to the regulators on it. They've given this the room to grow, to get real adoption, for consumers to discover it, for merchants to discover it. And clearly, this is opt-in. No one's forcing someone to use buy now, pay later. And $100 billion spend and millions of consumers. That is not... That's no joke of an industry. That is unbelievable growth, acting now at real scale. Consumers and merchants are saying, I really like this way of doing business. There's something about this that is fundamentally different, and it's more attractive to me than other options, paying with cash, paying with credit cards, you name it. And yet, as it's gotten a scale, absolutely there's the potential for abuse there by bad actors. And the regulator is now coming in, now that it's acting at scale, and going, look, you guys have done a decent job getting to this point. We've allowed you room to run. It's now getting to a size where we're concerned about where it could go in the absence of rules of the road that ensure that everyone continues to play fair. So we're going to collect the information we need to start setting up those rules. If there were, just take a very simple example, if there were 3 cars driving on a highway, to be honest, for the most part, it doesn't matter which side of the road we drive on. But as soon as you get hundreds or thousands of cars on the highway, it starts to matter a heck of a lot.
Yeah,
this industry has matured from a handful of cars, a kind of small cottage industry, to something much larger now. And that's when you start needing formal rules put in to make sure bad things don't happen.
So as we start to bring this home, what do you see ahead? There's a lot of innovation going on this. There's a lot of new companies. We're seeing big players acquire in this space. What do you see ahead? Because I think there's also, from our conversation pre the podcast, there's a crypto angle to this. Where do we go? What's the innovation that's happening in the payment rail space? Because this is changing the role of Visa and MasterCard and putting them out of the transaction flow and back behind and lower down in the stack. Where do you see the innovation ahead here?
So I think the place to start is exactly what you just covered. Buy now, pay later is the main interface between the merchant and the payment, the consumer and the payment, and Visa, MasterCard, the like are more of an afterthought. That's a massive, massive shift. Before we even get on to where buy now, pay later will go, where it will evolve crypto, I want to repeat, what we're seeing is a new way of consumers taking on credit, a new way of merchants acquiring customers. That is a massive shift. even if the regulations come down and put an end to this whole industry as it exists today, you've got millions of consumers and merchants saying, I like this transaction level underwriting. I like this ability to decide if I want a loan at the point of sale. I like this structured payment plan over a couple of weeks. Those are not going away. Those are changes that are here to stay. As this matures, as that underwriting model gets better, as we start to better understand how to finance this and the financing costs come down, as the costs of actually facilitating those payments come down, you're going to see buy now, pay later type activities move well beyond just, hey, we're going to work with Gen Z type customers to do high margin online commerce. We're going to see it start to extend to other types of larger payments. We know how to manage the risk better. We're going to see it extend to other types of product purchases, lower value product purchases. I believe it was Walgreens or CVS just signed a partnership to say, hey, we're going to allow you to use buy now, pay later for your everyday purchases in store. We're seeing a new alternative installment loan for consumer purchases. That's a wild innovation.
Paying for your Starbucks coffee over 4 installments is not that far ahead, is your point.
Absolutely not. And what's it going to take to get there? There's stuff under the covers of how buy now, pay later works that will continue to be improved, that will both reduce the risk they take on, they'll get better at underwriting, and it will reduce their cost base so that they have more margin to play with at the same price point.
We've hinted ahead at crypto. I think that's probably the point to stop you and interject and say, is that where we're going? Because if you look at this is still working, probably arguably on legacy rails with the credit card companies. Is that the point where crypto inserts itself and says, hey, and we've covered this on the podcast before, you don't need that legacy payment rail. There's another payment rail you could adopt. We're seeing the likes of Block, what used to be Square, enter this space. I mean, there's one word in Jack's Twitter bio, and we all know what it is. It's Bitcoin. Is that where we're starting to see the dots join up and say, hey, this might be a way to insert a new rail in here that unpicks the sort of stranglehold that the Visas and MasterCards have got? Is that the sort of breadcrumbs that we're tracking towards here?
That's exactly right. One of the biggest expenses for a buy now, pay later firm is as the consumer pays them those 4 installment payments, those installments are being paid through debit cards, through credit cards from the consumer to the buy now, pay later, off to whatever the bank is that needs to collect on that. That is going over the Visa net, that's going over MasterCard's network, etc. That's coming out of the buy now, pay later firm's margin. If they can switch off the Visa net, the MasterCard net, Amex, whatever it is, onto an alternative payment network like the Bitcoin Lightning Network, like Polygon to facilitate those payments, they're going to keep that margin. That is a massive, massive incentive to do so. Where I get really excited is where I start to see some of the combinations that are now emerging around this. Start with Square, Block, whatever we want to call it, acquiring Afterpay. Afterpay is now available to any merchant that's using Square's terminal to swipe cards or take phones or so on. Where they're going with that is they are going to make Afterpay available within the Cash App. That Cash App already is on the Bitcoin Lightning Network. So Square has set a very clear trajectory of, we are going to allow people, when they go into, take your pick of the store or online, if the merchant is using Square for point of sale, consumers will have the option of using buy now, pay later. And then when they go make the 4 installments out of there through the Cash App, that money is going to move across the Bitcoin Lightning Network, which allows us to keep a bigger chunk of it. Now, where I expect that, it's massive. Where I expect that to go is to start to look a lot like what PayPal has already done. PayPal's Pay Later, they offer it for free. And I truly do mean free here. It is zero fees. It is zero interest. It is zero cost to the merchant above what PayPal already charges them. PayPal has realized that consumers that use Buy Now, Pay Later have 2-3x larger basket sizes than other consumers do. More people will buy because they have access to credit and they can't get a credit card today, but now they can get access to an installment loan that allows them to pay over time. So PayPal is happy giving that product away, the BNPL product, away for free because they know they're going to make it up on the ongoing payments, on the merchant payments. They're getting more consumers and those consumers are spending more. That is PayPal's core business. I expect Square to do that even better because they can offer that same product, but offer it at every merchant at point of sale, give it away for free, and basically call up the merchant and say, you want this thing that costs you nothing additional beyond what you're already getting from Square, because you will get more consumers and those consumers will spend more. And if I'm Visa, if I'm MasterCard, that's a really scary barrel to be staring down. That's a big shift and a super valuable offering that a Square can make to its merchants.
And they're inserting themselves in that network effect that the Visas and the MasterCards have had access to and have had a monopoly on, arguably, for the last few decades. Jared, we're always trying to keep this to 30 minutes. I think you gave us a very good summary there. You've been listening to the Fat Tail Thoughts podcast, where we've covered the workings and makings of money, crypto, and the market. If you like the show, please click and subscribe and tell a friend. We're trying to build something here where we turn up every week. Please click on the newsletter and read that. And we'll see you on the other side. Thank you very much and speak to you next.